Hello, this is Derek as well, Chief Investment Officer for Shelton Capital Management, with another Shelton CIO Minute. To continue on the world tour we've engaged in the last couple of weeks, today I want to talk about Japan. Like most other international markets, their equity market is up fairly strongly year to date, about 5 or 6%. But Japan's markets have really been in the news more for what's going on in their bond market. Now, for many years, decades even, Japan has been holding their interest rates at or close to near zero. First, they did this using quantitative easing like we did in the US, but since 2016, they've engaged what they call yield curve control, where the Bank of Japan is buying certain parts of the yield curve, buying those bonds with their own money to keep interest rates extremely low, usually less than or their target rate of 25 basis points. Now, Japan has had inflation just like the rest of the world. It's less than 4%, but when you have zero interest rates, 4% is a lot. And the wage pressures in Japan have been increasing just like the rest of the world as well. And as a result, the Bank of Japan can no longer buy enough bonds to control rates in the way they have been for the last 6 years. And so in November, they announced that they were going to allow 10-year rates in Japan to rise up to as much as 50 basis points, and followed up with an announcement last week that they were going to maintain this level. Interestingly enough, the bond market doesn't believe that they can keep this under control, and the rest of the yield curve continues to bulge upwards with the belief that the Bank of Japan won't be able to maintain 50 basis points either. So what does that mean? Well, a couple of things. First of all, the yield curve is getting steeper in Japan because they're working with the longer end of the curve, unlike the US and other parts of the world where we're working with the shorter end of the curve. The yield curve is getting steeper. And this is actually stimulative to their economy, which is in contrast to all the restrictive policies that we've seen in the rest of the world. And as a result now, Japanese investors are now willing to invest more of their savings at home as opposed to abroad. Most notably, there's going to be fewer buyers of US Treasuries in the global market. And finally, this announcement in November has strengthened the yen considerably. Through October of last year, given the inflationary environment we are in and the rates going up around the world, the yen was down about 30% year to date versus the US dollar. But after this announcement, it is now reverse course and has recovered more than half of that 30% in the last couple of months. So on the margin, Japan is contributing to the inflationary forces in the global economy. It's happy to let inflation run in their own country. It's not controlling bond rates, not holding them on the long end. And they're also cutting back on their foreign bond purchases, which makes it easier for interest rates to stay higher. And as a result, when it comes down to it, Japan is providing as yet another reason for our own Federal Reserve to remain hawkish for longer. That's our CIO Minute for this week. If you have further questions, please feel free to contact your local Shelton Capital representative. Thank you.